Hello everyone and welcome to my Screencast assignment which focuses on adjusting entries. So firstly, what are adjusting entries? Adjusting journal entries are made to record revenues and expenses that have been earned or incurred but not yet recorded. Adjusting entries are required under the accrual, not the cash basis of accounting. There are two golden rules of adjusting entries. Firstly, adjusting entries involve one statement of financial position account and one statement of comprehensive income account. And secondly, they never involve cash. There are four main types of adjusting entries I'll be talking about today: accrued revenue, accrued expense, deferred revenue, and deferred expense. Firstly, we are going to look at accrued revenue. Accrued revenue is revenue that has been earned by providing a good or service, but payment has not yet been received. Now we will go through the first example. On April 30, Tiana deposited $15,000 into her bank account. The interest rate is 4% per annum. Record the adjusting entry for the end of financial year ending in June 30. Firstly, to calculate the interest per month, we have to multiply 15,000 by 8% times 2 over 12. This is because from April 30 to June 30, there's a period of 2 months. This will equal to $200. The adjusted entry on June 30 will be debit interest receivable and credit interest revenue. Now I will talk about accrued expense. Companies often incur and pay for them later. When this occurs, the company has incurred an accrued expense. For example, daily payroll is $5,000. The company pays its employees on Saturday 1/5 for the work done between the 26th to the 30th of April. The company prepares its financial statements on April 30, which is a Friday. The adjusted journal entry for this will be debit interest receivable and credit interest revenue. Now I will go on to deferred revenue. When a company receives cash before it provides a service, it has a deferred revenue or an unearned revenue. For example, a company sells 12-month subscriptions of a monthly magazine. On October 1st, the company receives a total of $1,200 for 20 subscriptions. The adjusted entry will be debit unearned revenue and credit service revenue. Lastly, we will look at deferred expense. When a company pays for a resource before it uses or consumes it, the company has a deferred expense or prepaid expense. For example, on the 1st of March, a company purchased a 12-month general liability insurance policy for $72,000. Therefore, it is $6,000 per month if we divide this by 12. The adjusting entry will be debit insurance expense and credit prepaid insurance. Thank you everyone for watching.